Good evening, welcome to Markets Today. I'm Lata Venkatesh, with me is Surabhi Upadhyay. Well, actually there was some good news in the markets today. The bank Nifty ended in the green. Quite a few bashed up PSU banks saw some green thanks to the Reserve Bank giving them more teeth to bite borrowers who don't pay back their money. And there was some green also in beleaguered stocks like Sun TV and Nestle, which have been beaten down for specific bad news in those counters. But there the good news ends. Ultimately, for the 7th straight day, the Sensex, the Nifty and the mid-cap index all ended in the red. Hi, Surabhi.
Hi, Lata. Let me try and find some silver lining there. The fact that we didn't break 8,000, it seemed so precarious at one point in time, but then a slight pullback. For what it's worth, the index managing to close above that peak. Let's quickly run you through the headlines. Another weekday on Dalal Street. Markets consolidate with the Nifty ending down 21 points but managing to hold above 8,000. The Sensex drops 40 points. Pharma, real estate and IT stocks see pressure. However, banks see some buying.
The mid-cap index underperforms blue chips, falling 0.4%. Tire stocks like Seat, Apollo and JK fall between 4 and 8% on rising rubber prices. Unitech drops 7% after the Consumer Court directs the company to pay compensation for delayed delivery of apartments. KC International bucks the trend, surging 18% on fresh order win news.
Kane closes down 4.5% on cash outflow concerns, while Vedanta gains 3% as Vedanta acknowledges the possibility of a merger between the two companies. Vedanta also says that it's evaluating a transaction with the Indian government with respect to Hindustan Zinc and Balco.
Investors remain jittery ahead of the MSCI, the Morgan Stanley Capital Index review on the possibility of Chinese A shares being included in the MSCI Emerging Market Index. And the inclusion of China A shares may reduce India's weightage, leading to an outflow of over $1 billion, say some brokerages. Well, those were some of the concerns on the market, some of the headlines, and here are the experts that we have lined up on the show for you. From the sidelines, the Morgan Stanley India Investor Summit, Jonathan Garner will tell us why he still remains overweight on India. Chetan Ahia, again of Morgan Stanley, and Aditya Puri, Managing Director and CEO of HDFC Bank, also join in with their interest rate expectations. We'll also tell you how bankers are reading RBI's big move to empower banks on their ability to get back defaulters to pay some money. All that's coming your way in the next half hour. But first, Surabhi, the markets.
Absolutely. So let's start with the action. Well, it was a day of consolidation today, and it's been 7 days in red. That's the only color that Dalal Street seems to know. Market slipped yet again as last hour played spoil sport, but losses were minimal today. The Nifty did manage to defend the 8,000 mark, but only just. The index is a few points away from that level now. The Sensex lost about 40 points to tumble below the 26,500 mark. No respite coming in for mid-caps either, as that index lost nearly 0.5%. Sonia Shenoy is now here with a wrap of the day's trading highlights. Sonia, 7 days running and still no respite for the bulls at least.
Oh yes, you know, 8,000 is just a psychological level. So while we may be pleased to see that that level has been defended on the downside, the fact of the matter is that this market is technically very, very weak. It's been 7 consecutive days of a fall, and now we're sitting at the lowest closing level since October of 2014. And the trends across all fronts are weak, whether it's the frontliners or even the mid-caps. In fact, today the Bank Nifty outperformed, so that's the reason why the Nifty could hold on to that 8,000 mark. But if you look outside the index, so many stocks are in a bear market of their own. Today we saw some a lot of larger non-index stocks like Apollo Tyres, Bharat Forge come under severe pressure, just indicating that it's just a matter of time before that 8,000 level gets taken out. So disappointing. Let me start with the key losers. Cairn India, when the merger with Vedanta goes through, Cairn India, of course, will be the biggest loser because Vedanta will have direct access to all of Cairn India's cash. Technology stocks like Wipro, Tech Mahindra and HCL Tech were under pressure as well. So all those stocks were down anywhere between 1 to 2%. Pharma was not too far behind. Cipla, Sun Pharma and Dr. Reddy's were down as well. All those stocks in the red. And PSU banks like Bank of Baroda and PNB saw some selling pressure. Both those those stocks in the red as well. But what salvaged the market today is the private banks. So ICICI Bank, Axis Bank were in the green. Even from the PSU lot, you had SBI that made an attempt to recover in late trade as well. Vedanta Hindalco did well. So both those stocks ended with gains of around 1 to about 3% and some cement names like Ambuja, Grasim and ACC too managed to buck the trend today, up about 1%. In the mid-cap space, as I was mentioning, the sentiment continues to remain weak. So you saw a lot of larger mid-cap stocks like Apollo Tyres, Bharat Forge, UPL, LIC Housing Finance come under selling pressure. And these are good quality, high pedigree names. So all of them down anywhere between 2 to 4%. And on the gaining end, you had names like Bajaj Finserv, ABG Shipyard, and some stocks that were under a regulatory cloud like Nestle and Sun TV saw a bit of a bounce back today. So those stocks were up in the green. In fact, Nestle saw a massive spike in late trade, up about 8%, and Thermax did well too. But all in all, you can say that the trend continues to be on the downside and the bears are in firm grip of this market. Back to you.
Point taken, Sonia. It doesn't require more belaboring, but just a word more on the bank stocks. Even if you looked at the manner in which the Reserve Bank's giving teeth to bankers to divest erring promoters of ownership of a company and find a new promoter, even this news has been interpreted as really more positive for private sector banks. The exposure of SBI, ICICI, IDBI, Canada is all very big for vis-a-vis infrastructure companies or large borrowers. But the biggest gainer today is really ICICI. Next to it is perhaps, banks like Federal. The biggest gains have not come to PSU banks because there is still a fear that private sector banks will use these powers more aggressively than public sector banks. But to be fair, of course, SBI is an exception to that rule. It's up 1%. The expectation is that SBI will be able to take up leadership in these fights. And to be fair, there has also been some kind of improvement in banks like UCO, Andhra, all of which also have tall NPLs. But, the beleaguered ones like Bank of Baroda or PNB, these banks have not, Canada Bank, all these have not yet been able to pull themselves up. And these are the three banks, Canada, PNB and BOB, which have lost actually year to date over 30% since January. In spite of the seminal weakness and in spite of getting this power, the gains today have been really marginal compared to the kind of losses they have seen. So clearly, even within the bank Nifty, there are more pockets of instability or weakness rather than power. It's only a handful of private sector banks, ICICI and Axis, that have shown some gains.
So perhaps market seeing is believing, especially with respect to some of these big banks where the problems are humongous, as Lata mentioned. All right, let's on that note move to some market opinion. India has the potential to see a significant uptick in growth compared to all other emerging markets. That's the word coming in from Jonathan Garner, Chief Asia and Emerging Market Equity Strategist of Morgan Stanley.
We don't think India is as vulnerable as other parts of our coverage universe this time around. So at this conference 2 years ago, we were very worried about what the summer might bring for India, but we're hopeful this time around that India will be more insulated from these problems than other emerging markets. In terms of India's near-term outlook, there's a better chance that growth picks up in India than almost anywhere else that we cover in the emerging world. And there's some early signs of encouragement in that regard, and that's the reason why we're actually overweight India within this overall bad environment in emerging markets. If you look out to the March 2017 year end, my colleague Ridham Desai, who looks after India for us in detail here, he's about 15% above consensus. That has an effect on the forward multiple on the market. If you use consensus earnings, then India's trading about 1 year forward about 16 times. And that's actually now back in line with long-run averages. All of the kind of Modi premium in Indian equities versus the rest of emerging markets has now gone. We're back in valuation relative terms to where we were at the end of 2013. That's why we've been looking to upgrade India. Okay, so that's a vote of confidence coming in from Morgan Stanley there on the Indian markets. Well, let's get you some more details on banks. Like we've been discussing, like Lata was just telling us, that the Bank Nifty stood firm today in a sea of red otherwise. And this largely after RBI's booster dose coming in for banks. Remember that the Reserve Bank of India has decided to allow lenders to convert dues or debt into equity should promoters default on restructured loans or not meet certain obligations that are part of a restructured
restructuring plan. Lata, you've been speaking to a lot of bankers since these announcements came out last evening. What's the sense? How successful will this step be?
Well, the key step that they've announced is that not only can you convert debt to equity, you can convert it at book value, which means, it would be around 10 rupees or even less than 10 rupees in several cases. Of course, under company laws, it cannot go, Companies Act, it cannot go below face value. It is the cheapness with which they can convert debt to equity that was the central announcement from Reserve Bank yesterday. Also, they said mandatorily in all restructuring cases, a conversion clause has to be put in. So no promoter can use his clout and escape that clause. It will be put in if a loan is getting restructured. Bankers and economists are extremely confident, so let's hear some of them out.
It's a very big positive because hopefully it will deter the promoters from not following the restructuring norms which have been laid down as a part of the restructuring exercise. So I think it should be a big positive. Obviously we need to wait and see the execution of this. So obviously the proof is in the pudding. We need to wait for that. But fundamentally I think this is a great concept. This should deter the promoters.
I think it's a very good enabler that has come and will certainly be a potent weapon in the hands of the banks to work with clients who mean well but have run into a problem. So I think this is a good enabler, and its use will definitely be situation specific and client specific.
Okay, those were the expert views, and now Ekta Batra is joining us to tell us how several leading brokerages have read RBI's move. Ekta.
Well, with regards to the brokerage reaction on the strategic debt restructuring norms that were announced by the Reserve Bank of India last evening, Realty says that the SDR, or strategic debt restructuring norms, is a step in the right direction. It would act strongly against willful or non-cooperative borrowers. It will make promoters more cooperative due to fear of losing control of the company. However, the SDR is not applicable to already restructured cases, plus cases where the revised payment terms have already been finalized unless agreed to by both parties. For both 1 and 2, which is the two options that I listed above, the banks may have to bear losses of the current stressed assets present in the system. JP Morgan has said that it is an incremental positive but not a magic bullet. Incremental positive as it is now a major disincentive for stressed promoters to stall negotiations on issues like asset divestment. This leverage for banks to negotiate settlements as well as asset transfers, but would not hope to actually have to take over the companies. So overall, JP Morgan has said that the biggest beneficiaries would be large corporate lenders such as SBI, ICICI Bank and Axis Bank. And to sum it up, it isn't a magic bullet for all stressed assets, but will make resolution significantly easier.
Thanks a lot for that, Ekta. Staying with the interest rates and banks, even though the Reserve Bank governor has signaled a slightly higher inflation by 2016 and perhaps no more rate cuts, eminent bankers and economists believe that the cost of loans for borrowers will come down by 75 to 100 basis points. That is 1 percentage point in the next 12 months. Here's HDFC Bank's Aditya Puri and Morgan Stanley's Chetan Ahya, who are betting on even further rate cuts from the Reserve Bank, actually.
I'd say straight after the monsoon.
Okay, when he's more clear.
I also feel that the bankers will cut rates, base rates. You'll see transmission much faster. Once we review our ALCOs there, once we review our deposit rates, so would you see a cut? I'd say yes.
Expecting another 50 to 75 basis points by March 16. You have to look at the weighted average yields on loans and advances. That would probably be down by about 75 to 100 basis points. And the other measure could be looking at commercial paper rate, which is already actually down quite significantly. That could also be down by another 75 to 100 basis points in another 6 to 7 months' time.
Okay, on that note, let's move on to another story that we are tracking. Perhaps the biggest blow to Tata Steel will be coming in the long products business post the UK Labour Union strike announcement. Sources say that the sale of the company's long products business to the Klesch Group, that was crucial to bring down the debt of the firm and strengthen its European operations, might be threatened. Kritika Saxena, who's been tracking that story now, gets us some exclusive details. Kritika, what are the implications here if this strike does end up being more than just a one-day phenomenon?
Well, you know, we already know that the biggest implication is the fact that operations will come to a standstill if there's an indefinite strike, which will immediately lead to losses for the company. However, the larger point over here was that Tata Steel has been looking at gradually making its European operation profitable. The long products business has seen lower EBITDA per ton, has not seen full capacity utilization for quite some time, and they have been looking at selling that. Over the last 1 year, they've had multiple conversations, and they finally found a buyer, that is the Clash Group, which was currently in due diligence for this. Now, what we understand, however, is that after the news of the likely strike has gone in, Clash Group has threatened to pull out of the deal altogether. We understand that they have indicated clearly that if there were to be a strike, more importantly an indefinite strike, they would be very wary of looking at going ahead with buying out that long products business. As you said, not only does this mean that Tata Steel's plans to bring down its debt fall apart, it also means that going ahead they will take a way longer time when it comes to stabilizing their European operations. Meanwhile, yes, Tata Steel is working to reach a mid-ground with the UK workers and create a revised pension plan. However, what they say is that they're working to ensure that the revised plan has a cost saving of around £850 million. And that is something that is slightly difficult. They need at least 3 to 4 days to firm up those plans. So yes, they have time till June 22nd to do that.
It's a lot for that, Kritika. Rusty problems, will of steel needed perhaps. We'll take a break on that note. Coming up, we'll tell you what to expect from the review of the Morgan Stanley Capital Index, the MSCI Emerging Market Index. We'll also tell you about other stocks that were in the news today.